the first half of the year is over, and we've had an incredible run. Best in ages. It's worth asking how much of this move was because maybe we never should have been down so much in the first place. Oh, you know what happened late last year. And how much of this is the real deal, though? In other words, what does this rally really signify? Given the incredible uncertainties in erratic Fed, trade tensions, slowing retail sales, genuine earnings disappointments, the rally in the first half of the year really did defy all of the pessimistic expectations. I want you to understand what drove this move, which is why tonight we're drilling down on the 5 best performing stocks in both the Dow Jones Industrial Average, and because the Dow Jones Average is a little bit atavistic, of course, we're going to focus on the S&P 500. We got to draw some conclusions about this market that could be helpful for the second half. Let's take them down. Biggest winner in the Dow? Microsoft. Mr. Softy, up nearly 32% in the first half. Now, how the heck did that happen? Simple. Microsoft's become the one uncontroversial large-cap tech stock, a trillion-dollar nobody that's living in peace with regulators all over the globe. Ironic? Think about it like this. Microsoft already had its antitrust reckoning 18 years ago. The once despised tech kingpin has become innocuous under the leadership of the quiet, earnest Satya Nadella. Nobody's calling to break up Microsoft like they are with Amazon, Google, and Facebook. It's the good guy. Can the stock keep roaring? Tough call. Microsoft's earnings haven't been rising nearly as fast as its share price. That means much of the recent move was called, let's say, multiple expansion. That's money managers paying more for the same set of earnings expectations. That's it. Microsoft's got it all. I mean, it's got Azure, it's got that tremendous cloud business, it's got fantastic business all over the globe. And you know what? Stick with it. Second and third best performers in the Dow are 2 credit card companies, Visa and American Express, up 31 and 29% respectively. They're both extremely well run, both terrific plays on the transition from paper money to plastic, which is still going on. There's just one thing that can stop them. If the banks themselves come back in style on the Wall Street Fashion Show, as they did today after those stress tests that were released last week, and maybe then the demand for financial technology stocks will dry up as money flows back into the much cheaper regular financials. Now, I don't think it's very likely, but it's certainly a possibility. Now, American Express definitely has the cheaper stock of between Visa and American Express. I think it's a better buy here. While the company had a good quarter, there's also some multiple expansion at work here, fueled by the fintech bull market. If you really want a credit card stock that's expensive but growing fast, I would go with Ma. That's MasterCard, as it's got the best runway for growth. Number 4, Disney, up 27%, one of the most unbelievable moves I've ever seen in my career. You almost never see a not-so-hot stock explode higher after the company holds a long-awaited analyst meeting. But that's exactly what happened here. Before CEO Bob Iger traced out his vision for Disney's future through 2024, led by a streaming video service, Disney Plus, and a slate of movies that are almost guaranteed to be blockbusters 3/4 of the year, investors only focused on ESPN, specifically how ESPN was losing subscribers thanks to cord cutting. Hey, now that's an asterisk. Like the genie in Aladdin, Iger's done the impossible. He's convinced money managers that the Disney franchise is so strong, it's worth holding on to the stock through the next few years for the big payoff in 2024, even though building out the streaming business will cost him a fortune. I think Iger's being conservative, though. Disney has terrific programming, which is why I'm betting Disney Plus will start breaking even earlier, maybe in 2022, maybe turn a profit in 2023. Now, if you're willing to focus on those out years, then this remains a fantastic story. But near term, patience is required. 5th best performer in the Dow, Cisco, CSCO kind, up 26%. Now, under the leadership of Chuck Robbins, Cisco has transitioned from a networking hardware play that was slow growing into a more diversified, faster growing business that has a lot of software and cybersecurity exposure. Largest cybersecurity company in the world, by the way, just buried within the company. The skeptics are still surprisingly thick on the ground. Which is one of the reasons why the stock's so cheap. Even though Cisco's in great shape, and it's sitting on, well, not as big a mountain of cash as it used to have, but still a mountain, I think it's got more room to run. Don't forget, Robbins saw the last round of tariffs coming and skedaddled out of China ahead of time. No estimate cuts there. If the new trade deal holds, maybe that doesn't matter. But if this deal goes off the rails, as so many people obviously thought through much of the day, Cisco will be fine. All right, how about the top 5 winners in the S&P 500? Many of these look like Cisco. There's stories where management made good decisions that are now paying off. Now, the best performer in the S&P 500 during the first half was Coty, cosmetics company. But given the Coty stock just imploded today and they announced a huge write-down, I'm gonna asterisk that one, okay? Number 2, Xerox, which is very much a never should have been down so much in the fourth quarter name. And put that one aside, too, because I want to help you make some money, not just be historical. For our purposes, the S&P's best performer was Chipotle, even if it was really number 3. Up 69% for the first half. Chipotle is a spectacular turnaround story led by the great Brian Niccol, formerly of Taco Bell. Niccol has breathed new life into the franchise, helping recover from the health scares, although it doesn't hurt that Americans have short memories from mass incidents of food poisoning. By the way, technologically, he is so superior to the old guys. Wow. Second, there's AMD, up 64%. Now, you probably heard me rave so much about CEO Lisa Su that you're sick of it. Don't turn the channel. What she's done here is nothing short of amazing. After spending 30 years playing second banana to Intel, AMD's now got some of the best chips for the PC, for game, for the data center. In fact, AMD's become more reliable than Intel. Holy cow, I just said it. I think it might be having the best quarter of all the semiconductor stocks, too. It's a buy. Number 3 is an odd duck, Cadence Design, up 62%. This company's always been a force in the semiconductor design business, but, I mean, lately it's become the premier subscription-based intelligent systems designer. Reminds me of Autodesk, by the way, which was up big today. I think this stock could have more upside. I remember from the old days, I used to have a huge stake in it when I was a hedge fund manager. The 4th best performer in the S&P, when we move aside to Cody and Xerox, is MSCI, run by the great Henry Fernandez. It's up nearly 62%. This is one of my favorite companies. If you want to invest in emerging markets, MSCI is the keeper of the indices and all the data and the analytics tools you need. And growth-seeking portfolio managers love emerging markets, even though they're incredibly risky. And that's why MSCI has become the star of the fintech space. More room to run. Finally, here's a weird one. Hess, up 57%. To me, it feels like there's hot money coming into this oil stock. Hey, maybe they're speculating the Hess could be a takeover target like Anadarko now that Chevron's looking for something. I think that's very unlikely, though. If you own Hess, maybe you want to ring the register. Bottom line, when I look at the top 5 best performers in the Dow and the S&P, I see a good group of stocks, most of which have more room to run. As we've seen over and over this year, stocks that are in motion tend to stay in motion, especially when they're going higher. Maybe they get knocked down by big picture worries, by sell programs. But if you got a quality story like a lot of these, the odds are good the stock's going to get right back on track. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.